The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender at NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettler, along with Accunet Mortgage and Accunet Realty Advisors owner Brian Wickert. David Wickert is, in Kentucky, sipping on a mint julep after the Kentucky Derby? Is that the plan there?
Yes. He texted me and said, thanks for the day off, and I asked him if he won any money, because I think you can bet on that Kentucky Derby thing while you're there, right? He said, nope. He doesn't have a good line on the ponies, but he said it was both sunny, rainy, and cold yet warm. So apparently they had quite a day of weather down there at the Derby. Anyhow, we got a lot to talk about. I kind of over-prepared, Steve, without my sidekick here. I got a lot to talk about. And let's get started with it's just you and me, buddy. But that's just like what we call the old days. So let's get started talking about that jobs report for April and remind everybody why we care. The reason that mortgage guys care and home shoppers, homeowners, realtors is that the jobs report every month is one of the two key indicators that the Federal Reserve looks at to determine when and how much they're going to raise interest rates. The other key indicator, by the way, is inflation. Another reason why I think mortgage guys and real estate agents care is you kind of need a job if you're going to get a mortgage and buy a house. So it's a pretty important number. So the number of jobs created is 211,000 new jobs in April. The consensus forecast was 180. And I thought, that's really a meaningless number. So I went to a baseball game lately, a week ago Friday. Miller Park holds 42,200 people. So that means the U.S. economy created 5 completely full Miller Parks of jobs. Think about that. That's a lot of people. 5 full Miller Parks full. And that means those are people who either got a job for the first time or came off the sidelines, from either being employed or maybe not working for a while. The average, by the way, for the first 3 months, or the most recent 3 months for new jobs created, it's 173,000. It takes, by the way, 145,000 jobs per month just to absorb the new workers. That's a lot of jobs. I'm glad I don't have to create all those jobs. The other number that is widely publicized, the unemployment rate is 4.4%. That's the lowest unemployment rate we've had since 2007. Now, just as a reminder, because I'm, kind of wonky like this, as a taxpayer, the number I really care about isn't the unemployment rate. It's not the number of new jobs created, although that's an important one. I really care about the actual number of people who are working, like really the number. And that's because people who are working are the ones who pay into Social Security and Medicare and Medicaid. Yeah. By the way, over half the federal government's $3.65 trillion spending goes towards Social Security, Medicare, and Medicaid. All right, so according to the Bureau of Labor Statistics, 153.2 million Americans were working in April. That's 2.1 million more than a year ago, to which I say, hooray. Now, the other number that's just as important, or maybe second important, to me as a taxpayer, is the number who are not working and the ratio between the two. So if you lined up a perfectly representative group of 1,000 working-age Americans, which is anybody over the age of 16, 602 of those 1,000 would be working and paying payroll taxes. Only 44 would be looking for work. And 364 would either be retired or simply choosing not to work or not looking for a job. That's probably the best set of numbers I've come up with in a few weeks, right? Out of 1,000, you got 602 working, 44 looking for work, 364 who are sitting on the sidelines. So that comes to a 60.2% employment to population ratio. All right, one last nugget before we tell you what happened to rates as a result. Wages were up 2.5% from a year ago. And average hourly earnings for the week, that puts that at $26.19 per hour, and the average work week was 34.4. So if you want to know whether or not you are above average relative to the income of an American worker, the average is $46,800 per year. So if you make more than that, you're above average, and if you're there or below, you're a little below average. All right, when we come back from this first break, Steve, we're going to reveal what happened to mortgage rates as a result of that pretty good jobs report. We'll do that when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, one college player injures himself in a bowl game only to see his stock fall in the NFL draft. Meanwhile, other college stars are sitting out their bowl games to become top 10 draft picks. Should college football be worried? Greg Matzik takes a look at this at 7:30 Monday night on Sports Central right here on WTMJ. Right now, though, Brian Wickert is with us. It's the Accunet Mortgage and Realty Hour here on WTMJ.
So the April jobs report was a little better than expected. Normally that would have pushed mortgage rates up, but it didn't. So we ended the week at low overhead Accunet Mortgage at a rate of 3.99%. That's on a $200,000 30-year fixed rate loan with 25% equity and all the other right stuff with no points. And our usual low loan costs of just $1,180. That includes your appraisal, the closing, the title insurance update, credit report. Remember, we do not charge any junk fees, underwriting fees, loan processing fees, anything like that. But nonetheless, the APR is 4.02%. The 20-year fixed ended the week at 3.875, and you only had to pay $380 of closing costs to get the 20-year fixed. That makes the APR 3.91, and that's a great tool for refinancing. If you can go from a 25 or 26 years remaining and get down to a 20-year, you will save a ton of money. And the 15-year fixed closed the week at 3.25, also with no points. That makes the APR 3.29. So that's good news that despite the better jobs report, mortgage rates stayed the same.
Yeah, usually good news there means bad news for mortgage rates. But when you look ahead to June, where do you see the Fed going with maybe a possible rate increase?
I did look that up just because I wanted to know, and the answer is there's this thing called the Fed Funds Futures Market, and it's where you can bet, basically, on whether or not the Fed's going to raise rates. And the odds of a quarter-point hike in June are 78.5%. That's pretty high.
Yeah.
So, I think the market kind of knew that, right? That didn't change from Thursday until the end of the day on Friday. It was the same before and after the jobs report came out. So no surprise.
Well, it's been just a lightning hot market, though, for sales right now. It's a seller's market.
Absolutely. And in fact, when we come back here after our next break, we're going to talk about exactly what the multiple listing service has to say, as far as April results go. And then we can also look at a number that I just saw come across the wire on home price appreciation, most recently for the state of Wisconsin. The number that I have to share is not specific to cities. That'll be coming out later in May, but this is the most recent statewide number. So we'll talk about how hot the market is. How hot is hot when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ. And if you have a question, you can call it in or text it in on the Accunet Mortgage talk and text line. That number is 414-799-1620.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, if you missed the riveting interviews from John McCure's special this past week on the anniversary of the Alexis Patterson disappearance, we've got you covered. You can tune in tonight at 8 o'clock to hear a special encore presentation featuring the voices of those who knew the little girl and still want answers. WTMJ News presents the disappearance of Alexis Patterson tonight at 8 o'clock on 620 WTMJ. Brian Wickert is with us. It's the Accunet Mortgage and Realty Show. It's a hot market if you're a seller. It's a seller's market, which leads us to a situation that can give you a real good example of just how you cannot be a contingent buyer in this market.
That's right. Yeah, so before we get to the April numbers, which will show us how hot the market is, I got a call Friday afternoon from a couple that had been pre-approved by USAA, big national lender. They do insurance and they do some mortgages too. And they were told there was no way they could buy their next home without selling or making an unrealistically large down payment on the new house. So they quickly figured out that, hey, if we're going to win, they're looking in the price range of $450 to $500 in Waukesha County. And they quickly realized, hey, if we want to win in a multiple offer situation, we cannot write a contingent offer. That's just the kiss of death. You know, if you got more than one offer, the one you're going to put to the absolute bottom of the pile is the one that says, yes, contingent on the sale of my home. So their agent recommended they call Accunet. I did a three-way call with the husband and wife, got the lay of the land, took their application right over the phone. That maybe only took about 15 minutes, and came up with this winning formula. The formula is to give them a bridge loan on their existing house. They had a first mortgage, a 15-year fix, which of course means a higher payment, and they had a second mortgage to do a kitchen remodel. So we have resources where we can give them a bridge loan, which is simply a home equity loan where we pay off the existing mortgages and extract the equity from their old house. And we can lend up to 80% of the value of the old house. We have a bridge loan partner now that doesn't even require an appraisal, which is slick.
Wow.
They'll go off broker's opinion of value. Yep, that saves a lot of money. Or the listing contract if the house is listed. So that is super slick. And so we're going to extract that equity. Now, that wasn't quite enough to make the down payment because, again, the object of the game when you're trying to help somebody buy before they sell, from a lender's perspective, is you have to be able to carry both home payments on the old house and the new house simultaneously. All right, so that's the burden of proof. The other thing that we had to do, or the other kind of benefit of the bridge loan, is the payments don't include any principal. You just have to make the interest payments. And in fact, on this particular bridge loan, now that I think about it, the really cool thing is, while we have to qualify the home buyer using the interest-only payments on the bridge loan, there are actually no payments. The interest just accumulates, simple interest, by the way, not compound interest. And at the end of 6 months, if you haven't sold your house, then you have to pay the 6 months interest that are due. If you sell your house, after month 4, you just pay the interest when you close. So it's really kind of a powerful tool. The other part of the equation, though, is they had to get a gift from their parents for the remainder of the down payment, and then we would lend them 80% of the purchase price on the new home. So instead of being contingent, instead of making their offer contingent on the sale of their existing home, we just had to include an extra financing contingency that said, yes, it's contingent upon the approval of the first mortgage and also closing of that bridge loan. So much more attractive, though, in the big scheme of things than having to sit there and write the offer contingent on the sale of the existing home. So there's your story. I've got one other story for later in the show where we're going to rank, and maybe we can, let me throw this out there. Don't answer this right now, but would you rather have a cash offer that included an appraisal contingency? And remember, the appraisal contingency in Wisconsin is if the appraisal comes in $1 less than the asking price, I, as the buyer, can cancel the deal. So would you rather have an offer, if you're a seller, put on your seller hat now. I've got 2 offers, same price. One of them's a cash offer, but it has an appraisal contingency. The other offer has mortgage financing, but let's say that one has a rock-solid guaranteed pre-approval. from Accunet Mortgage attached to the offer, but it has no appraisal contingency. Which one would you rather have? One with financing and no appraisal contingency, or a cash offer but including the appraisal contingency? Let's talk about that one when we come back from the news. And then we're also going to talk about what happened with April home sales in southeastern Wisconsin. I've got the numbers for the 5 counties. And I think you're going to be a little bit surprised at what we're finally seeing happening here in April. We'll talk about all those things when we come back after the news.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ. And if you have a question, you can call it or text it in on the Accunet Mortgage talk and text line. That number is 414-799-1620. We're coming up on 10:30 on this Sunday morning as we welcome in from the WTMJ 24-hour newsroom, Colleen Boland.
Thank you, Steve. A brief election.
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert is with us. David Wickert off this morning. I'm Steve Kettlear. So we're in the situation where we're talking about it's a seller's market. It's really hot out there. If you're a buyer, you just can't come in as a contingent buyer. And if you're a seller, you really want to be looking at the offers that are coming into you and picking the best one.
Right. So the question we just posed before the news break was, which one would you prefer if you're a seller? Would you rather have a cash offer, but also an appraisal contingency, which allows the buyer to cancel the contract if the appraisal comes in a nickel less than the agreed-upon offer price? Would you rather have that? Or would you rather have a loan that has a financing contingency with a rock-solid guaranteed pre-approval from Accunet, but no appraisal contingency? All right, you go first. Which would you rather have?
Well, because I've been doing this show with you for so long and I've learned so much, I'm going with the rock-solid pre-approval offer, and here's why. This market is so hot, appraisals might have a little difficulty keeping up with the times, so to speak. So if you're going to pin your hopes on an appraisal, that contingency could hang up your cash offer because the information isn't getting in the pipeline fast enough.
You're right. That's exactly my opinion. Now, I posed this to a friend of mine who just sold his house. He said, I take the cash buyer because, I think that they would negotiate on the appraisal. Well, but my perspective on that is, hey, there are actually 3 negotiations on every, or potential negotiations on every home sale. There's the one up front, right, where you're going back and forth. Okay, what price? Then there's the negotiation that often happens over the inspection. What's a defect and what's not? What are you going to fix? Or are you going to give me a credit because I found you have rotting wood on your porch or something like that? That's the second negotiation. And the third potential negotiation is over the appraised value if there's an appraisal contingency. And so I'm with you, Steve. I think in this rising multiple offer environment where many homes are selling over the asking price, the bigger risk is that appraisal coming in short. Now, here's a tip. If you're a first-time buyer, the minimum down payment is 3%. Okay? If you're a second-time buyer, repeat buyer, the minimum down payment is 5%. So if I gave somebody a rock-solid pre-approval to buy with a 5% down payment and they were a repeat buyer, and they waived their financing, or they waived their appraisal contingency, they would still be 100% protected. Because if the appraisal came in low, I could no longer lend them 95% of the purchase price.
Oh, good point. Sure.
Okay, so that's kind of a not such a great situation for the seller. But if I have that rock-solid pre-approval letter with 10% down, I have a 5% leeway. And so I've talked to some buyers about that and explained to them, if you're making an offer at $300,000 without an appraisal contingency with 10% down, you're going to have to buy that house if it appraises as low as $285,000. Because I can still make that same loan amount to you that you originally signed up for and put in your financing contingency. And a lot of buyers, after they've been through this process of losing out on offers, are cool with that.
Sure.
Right? Because it's like, I don't care. And I said this to somebody the other day. After you've been looking for a house for so long, in a specific market, you're more of an expert on what homes are really worth than what the appraisers are. And remember, the appraisers are handicapped because they have to look at the past. They have to say what has actually closed in the last 6 to 12 months. People who are actively out there shopping, which includes real estate agents and home buyers, they know what's available on the market and what they've lost out on. They've got
and
a
where it's
sense
going.
for where the market, exactly where the market's going. I'll blurt out that CoreLogic is the company that now owns the Case-Shiller Home Price Index. And their latest number, which just got published but is reflective of home prices as of February, has home prices up the last year 5% in the state of Wisconsin. And they are bold enough to predict 3.7% annual appreciation over each of the next 5 years. So my thing is, so what if you pay 3% more, for a home than what it appraises for? As long as you can get the financing, it's going to be worth more over the next 5 years, if everything goes right. Now, I've been teasing it too long. I got to give you the numbers. Single-family home sales in southeastern Wisconsin were down 6.4% in April compared to a year ago. And I think that has to do with our low inventory situation finally catching up with us. All the other months this year have either been just a little higher or, higher than a year ago. But now we're down. That means 106 fewer single-family homes sold in the 5-county metro area than last year. 1,553 was the number. The median price was up 9.1% from a year ago to $214,900. The number of new listings of single-family detached homes was lower in April by 225 homes compared to a year ago. There were 2,266 new listings for single-family homes that came in the market. The silver lining, I'm going to try, at least there were 700 more new listings in April than there were closed sales. So the inventory is growing, but it's still a tight market. All right, when we come back from this next break, I've got another story to tell about the relative attractiveness of various offers, and then also want to talk about the tax simplification proposal from the Trump administration, because that's getting a negative reaction from the National Association of Realtors and home builders. We'll talk about all that when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, you can cross the Marcus Corporation off the list of names for the new Bucks Arena. CEO and President Greg Marcus says a naming rights deal just doesn't make sense for them. Find out why not when he goes one-on-one with our Eric Bilstad during WTMJ Conversations starting up at 11:07 this morning. Brian Wickert is with us. I'm Steve Kettlear. It's the Accunet Mortgage and Realty Hour here on 620 WTMJ. In our final segment, we'll take a look at some news that has just recently popped regarding student loan debt and how that affects buyers and sellers. It's coming up here. But right now, we want to pull into the conversation John, who joins us from Franklin with a question about VA loans. Good morning, John. What's your question?
Good morning. I went on the line and I got a couple calls. Everyone who calls me is different on the VA loan, and I'm not sure how it goes. It won't be my first time home. I'm selling one now, but the thing is, I was told to go with the VA loan on my next house, and one guy says it's a low percentage rate, another one says it's 0% rate. Who do you believe?
You believe your friends from Accunet Mortgage. John, first of all, thanks for calling into the show. And thanks for your service to our country. What branch of service were you in?
Army, 8 years.
Army. Okay. All right. So the question about whether the VA loan is best for you depends on a couple things. First of all, what's your down payment going to be on the new house?
Roughly around $20,000.
Okay. On a purchase price of?
Roughly no more than $300,000.
Okay. So, all right, so the good thing about the VA loan is that there is no monthly mortgage insurance, okay? And I'm just looking at my screen right now. Our rate, and this all depends on your credit score and everything, the rate on a VA loan would be around 3.5, maybe even 3.375, and that's a lot lower than it would be if you got a regular Fannie Mae loan. And so then the only drawback to a VA loan, John, is that it comes with an upfront VA guarantee fee. So it's kind of like mortgage insurance insofar as you're paying a fee to the government for guaranteeing your loan. And so that number, by the way, the VA allows you to finance that so you don't have to pay it out of pocket. And that number will depend on whether or not you've used your VA eligibility before or not. So here's the best news, John. If you leave your name with Ben, the producer, I have got a loan consultant on staff who is a veteran. Now, he was in the Navy, so I hope that's okay. But he is our VA loan expert, and he will be able to lay out for you side by side and either prove or disprove whether or not VA is the best option for you. So thanks again for your service to the country and for calling in. We'd love to take care of you as our next customer. So it's a good thing. We added VA loans to our lineup about 6 months ago, and luckily we've got a bona fide expert on staff. Let's see. One thing I can tell you quickly about the condo market for April is it too was experienced fewer home sales than last year. 28 fewer condos sold. That's an 8.4% drop from April of 2016. Median price also was up 9%. And again, listings were up, or more condos were listed, 476 than were sold in which the number was 305. So at least our inventory is growing on the condo side as well. All right, when we come back from this last break in the show, let's get to that student loan news, and we might just have to punt until next week when David's back for the implications of the tax simplification program. But we've always good to have something in our hip pocket. So we'll talk student loans when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And don't forget, Brewers from Pittsburgh against the Pirates starting up at noon today here on WTMJ. Brian Wickert is with us, the Accunet Mortgage and Realty Hour here on 620 WTMJ. So this news that just came out with regard to homeowners and home buyers with significant student loan debt. What's going on here?
What's going on? All right. So as a reminder, people who have student loans can make payments in several different categories. First of all, they might be on deferment where they don't have to start paying them back yet. The most common category I would tell you that we see is where the students are making income-based repayments. And so let's say you had $50,000 of student loans. Maybe you're only being required to pay $100 a month. Why? Because that represents like 10% of your income, okay? Or something like that. There's a kind of complicated formula. But really, that payment on the income-based plan isn't even enough to cover the entire amount of interest. So your loan balance is going up. So a few years ago, Fannie Mae and Freddie Mac came out and said, and those are the two big entities that control the normal 30-year fixed rate. And they said, you know what, when somebody's not even making a payment on their student loan that's big enough to cover the interest, we can't use that when we're qualifying them for a home loan because someday they're going to have to start making principal and interest payments. And so they came out with a rule that said you got to use 1% of the loan balance as the qualifying monthly payment. So on my $50,000 student loan debt example, instead of being able to use the $100 a month that the borrower is actually paying, we have had to use the $500 a month 1% rule.
Yeah.
Well, that's a big deal. I mean, think of it. If you have $100,000 of school loan, now all of a sudden you got $1,000 of student loan payments we have to use to qualify you for a loan. Well, Fannie Mae just reversed their position, and so did Freddie Mac. And so they've come out and said, you know what? we'll let you use whatever payment is on the credit report as long as it's not marked as being an estimate. Well, and from our experience, most of them are not marked as estimated. So now the only thing that we'll have to use the 1% rule on are people who are in deferment. All right, so that's one big thing. We should be able to start doing that maybe as soon as next week. And that's a big deal, I'm telling you, for people who have significant student home loan debt. To qualify for more house. Okay, the other thing that they did is they said, if you're going to refinance your house and take some cash out to pay off student loans, we will classify that as a normal refinance. We will not put you into that riskier, worse-priced category of a cash-out refi. That's a big deal. So now they're saying, hey, we, Fannie Mae, will allow you to refinance your home mortgage. So this applies, of course, to people that already own a home. But they're saying, we'll let you take cash out to pay off your student loans, and we will price it like a normal refi. That is cool. And I'm hoping that we'll have that available next week as well. Because depending on how much equity you have left in your house, well, for one thing, on a cash-out refinance, you can normally only borrow 80% of the value of your home. And so I'm hoping that this change will allow us to help people borrow maybe up to 95% of the value of their home. And believe me, some of this student loan debt is not at very favorable interest rates, depending on when you took it out. So that's the update on student loans. All good news. The FHA, by the way, and I just sent over to your screen, Steve, a comparison.
Yeah, I see it right here.
Borrower that we're pre-approving. Yep, that we're pre-approving right now. And it turns out that an FHA loan, which is still going to go by the 1% rule, unless, of course, they change their mind, an FHA loan for these borrowers is the best option. And it results, as you can see, because they only have a small down payment, and their credit score is 685, which isn't terrible. But when you put only 3% down on a Fannie Mae loan, I want to draw your attention to that mortgage insurance line. The PMI cost is $260 a month when you have a combination of 3% down and a 685 credit score, whereas the FHA mortgage insurance is $100 less. Plus, the rate is better on an FHA loan because it's government guaranteed all the way. So it turns out that their payment is $150 less per month by going with the FHA loan than a Fannie Mae loan with 3% down. But here's the conversation I had to have with them yesterday because I was helping them find a real estate agent through Accunet Realty Advisors. FHA financing is not attractive when you're a seller. And it's because, in this case, it typically means small down payment. And then sellers rightly perceive that FHA appraisals are pickier than regular conventional appraisals. So they are going to have a hard time winning in multiple offer situations using FHA financing. Because when you're comparing that, you got 3.5% down on an FHA loan. This other person has 10% down on a conventional Fannie Mae loan. That 10% down is going to win for two reasons: down payment and perceived easier financing. So they are just going to have to be a little bit more patient in their home shopping process or bite the bullet and go with the higher payment. So we'll let you know how that turns out. All right, that's all the time we have this week. We'll be back with David next week, Steve, and we'll be talking about the tax simplification proposal and how that is going to affect homeowners. And remember, if you want to save money, the rates are still low enough to do that, or if you want to get started on the rock-solid pre-approval to buy, just go to Accunet.com and click on the blue button. That's ACCUNET.com.
We'll see you next weekend. Colleen Bolin joins us next from the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.